Hello everyone, welcome to Crack Grade B online learning platform. So guys, today we are going to start afresh with Accounting Standard 11 that stands for Effects of Changes in Foreign Exchange Rates. So, Accounting Standard 11 that is Effects of Changes in Foreign Exchange Rates. So what is the objective of this accounting standard? So, an enterprise may carry on activities involving foreign exchange in two ways. So, first one is it may have transactions in foreign currencies or it may have foreign operations. So, we know that this accounting standard will deal with the foreign exchange rates or the foreign exchange transactions. Only then we will deal with the rates. So, an enterprise that carries on activities in foreign in two ways. Either it has transactions in foreign currencies or it has foreign operations. We will later on know the meaning of these two sentences. Right now we are giving it a raw learning. In order to include foreign currency transactions and foreign operations in the financial statements of an enterprise, transactions must be expressed in the enterprise reporting currency and the financial statements of foreign operations must be translated into enterprise reporting currency. So they say they have used a term reporting currency or enterprise, that is the reporting enterprise. So now if you have a branch or the principal business in India, since you are an Indian resident, so you have the principal place of business in India. Now you have another branch in say USA. So now your reporting enterprise or the principal place of business is known as the reporting enterprise, and the other branch, that will be where the foreign operations will take place. So what will be the reporting currency in this case? Indian rupee. That will be the reporting currency if the reporting enterprise is in India. So this accounting standard says that if we are taking or incurring any foreign currency transactions and in order to include them in the financial statements of the enterprise in Indian branch or in Indian place of business, if we want to include the transactions that have been taken place with the USA branch, we need to express those foreign transactions in the Indian rupee. Only then there will be a comparability and an understanding of the foreign currency transactions and also the financial statements of the uh, reporting enterprise. Say if you are all the transactions have been taken place in Indian rupee, but there is one transaction, say credit purchase or anything in the foreign currency, and if you mention dollar and the other transactions are mentioned in rupees, it will not draw any conclusion because you need to change the rupee, the dollar into rupee in order to understand the financial statements correctly. So they say the principal issues in accounting for foreign currency transactions and the foreign operations are to decide which exchange rate to use and how to recognize in the financial statements the financial effect of changes in the exchange rates. So we know that Indian rupee or foreign currency, it is all very dynamic in nature. It keeps on changing. Say if you check for this particular hour, you will find it different, and if you check it an hour later, you will find it a bit different in paisa as compared to the dollar in rupees. So it is always changing. So they say if you have undertaken any foreign currency transaction, what is the rate at which you will record the transaction? So this is what we are going to deal with in this chapter, that in order to include the foreign exchange transactions in our reporting enterprise, then at what rate we need to take it. So next we have, in nutshell, objective of accounting standard 11 is enterprises carrying on activities involving the foreign exchange will have transaction in foreign currencies or they will have foreign operations. We will get to these two in next slides. So both of them, they have to be translated into dollar. Translation of dollar into the enterprise reporting currency. It can be any other currency over here in place of dollar as well. For an example, it has been written as dollar, and then to include them into the financial statements of enterprise. And here we have the principal issues in accounting are which exchange rate to use, and how to recognize the financial statements in the financial statements the financial effect of changes in the exchange rates. So these are the two things that we have seen before. It may have transactions in foreign currencies, for example, travel and tourism. Now, if you go to abroad for travel purposes, say Bangkok or here in USA, you need dollar, or you need the what we call it here, Thai baht. That is the currency of Bangkok. So you need the currency of that place to travel there. Also, if you're buying something over there, say any food or dresses or anything you buy there, you need to pay them in their currency. So for that also you have undertaken a foreign transaction. So this is the example. And if it may have foreign operations, it is just the case when you have a place of work or a branch in the other country. Say one place of business is in India and the other one is in New York. So at that time we say that you have foreign operations. So these were the two cases, and these are the two situations that we will deal in this chapter, the objective of recording them in the financial statements. Then we have the scope of Accounting Standard 11. Now this statement should be applied in accounting for transactions in foreign currencies and in translating the financial statements of foreign operations. So what it means is, in accounting for transactions of foreign currencies and for translating the foreign operations, this accounting standard will be applicable. Then this statement also deals with accounting for foreign currency transactions in the nature of forward exchange rate. So right now we saw two types of transactions that we will deal with in this chapter. That was first when you have transactions in foreign currencies. Say you buy any object, plant and machinery or anything like that. And second, when you have branch abroad. So these were the two things, and the third one is written over here. That is when you have transactions in the nature of forward exchange contracts. That means when you do speculation or you have any investment in the foreign exchange transactions. So that is the case. Here we will deal with this later on in detail. Now you have, this statement does not specify the currency in which an enterprise presents its financial statements. However, an enterprise normally uses the currency of the country in which it is domiciled. So they say that if you have a place of business in India and the other place of business in New York, so you have two currencies involved, that is rupees and the other one of the New York. So they say this statement or this accounting standard 11, it does not specify the currency in which you will present your financial statements. Say in India, you should usually use the currency of the country in which it is domiciled. That means in India, you should usually use rupees, but this accounting standard does not clearly force you or compel you to use that. If it uses a different currency, this statement requires disclosure of the reason for using that currency. So if you are using any other currency than the Indian rupee, then you have to state the reason for that. You have to disclose that fact. And this statement also requires disclosure of the reason for any change in the reporting currency. Say earlier you were using any other currency, but now you have decided to change the financial statements and represent them in rupees. So you need to disclose that fact that you have changed the reporting currency and why you have changed it. Next thing we have, this statement does not deal with the restatement of an enterprise financial statements from its reporting currency into another currency for the convenience of users accustomed to that currency or for similar purposes. So this means that when you were working abroad, say in USA, then you do not need, if you are preparing your financial statements in Indian rupee, so for the purposes of the other country in which you have a branch in USA, you do not need to provide them with your financial statements in their currency for the users accustomed to that currency or for any similar purposes. So that is the reason over here, that you do not need to provide them with the financial statements in their currency. This statement does not deal with presentation in a cash flow statement of the cash flows arising from transactions in a foreign currency and the translation of cash flows of a foreign operation. So you do not need to prepare any cash flow statement which will represent the cash flows arising from the transactions in foreign currency, and since you do not need to make any cash flow statement, you do not need to translate into that currency in which those transactions have arisen. Next, this statement does not deal with the exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to the interest cost. So here is an exception or an exclusion from Accounting Standard 11 that this standard will not deal in the exchange differences that will arise from the foreign currency borrowings to extent that they are treated as an adjustment to the interest costs. So yeah, that was the scope part. Now here are some important definitions. That means the first one here is the foreign currency. It is a currency other than the reporting currency of an enterprise. I have already given you an example for this one. In our case, dollar was the foreign currency when you had the principal place of business in India and the other place of business outside India, that was in USA. Average rate is the mean of the exchange rates in force during a period. So as I just told you that the exchange rates of any country, they keep on varying. They are dynamic in nature. They will keep on changing themselves every day, every year. They will keep on changing. So what happens when we record transactions? We usually take an average. So we will study about that later, but for the purposes of what an average rate is, it is the mean of exchange rates in force during a period, say for 3 days, 1 week, 1 month. That is the average rate. We have closing rate is the exchange rate at the balance sheet date. Now, the balance sheet, it closes on 31st March of any year, right? So in between, whatever transactions you have taken place in foreign currency, you record them at the exchange rate of that day, but the closing rate of any foreign currency is that exchange rate which is prevailing at the balance sheet date, that is on 31st March of that year. Next, we have exchange rate is the ratio for exchange of two currencies. So we usually denote $1 will be equal to 70 rupees. So this exchange ratio of the two currencies is known as the exchange rate. Okay. Then we have exchange difference. It is the difference resulting from reporting the same number of units of a foreign currency in the reporting currency at different exchange rates. Okay, let me simplify this for you. It just means like you undertook a transaction and you bought a machinery from New York or say USA, and you bought it for at a price when the rate was $1 equals to 70 rupees. But when you had to pay for it, it became $1 equals to 72 rupees. Now for every dollar, you have to pay 2 rupees extra. So that difference that happened between the date you purchased and the date on which you paid, there is a difference in the exchange rates, and that is known as the exchange difference of how the currency, the reporting currency, may depreciate against the foreign currency, or it may appreciate in respect of the foreign currency. So that is always the exchange difference. Then we have integral foreign operations. You do not need to read this from here because we have another slide, one whole slide for that. We will read that there in detail. Then we have the fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. We have also covered this definition in some earlier videos, but let me re-explain it to you. It is just that if you go to a person, any store, and the MRP is written over the product and you are not a relative, so there is like nothing you can get a benefit out of your relative, that he will ask you to pay less money on it. So fair value is the amount for which an asset could be exchanged between willing parties in an arm's length transaction. And then we have foreign operation. It is a foreign operation is a subsidiary, associate, joint venture, or branch of a reporting enterprise, the activities of which are based or conducted in a country other than the country of the reporting enterprise. So this definition is very easy, and we have already seen this with an example. So the next one over here is the forward exchange contract. It means an agreement to exchange different currencies at a forward rate. So these type of transactions are entered into for the purposes of speculation. Here there is no actual buying or selling. It is just that we want to gain for the from the exchange difference. इन हिंदी वी कॉल इट सट्टा करना या फिर शर्त लगाना कि हाँ फ्यूचर में उतना रेट हो जाएगा. तो we just gain or benefit from the exchange difference over here. We will read this concept later on in detail, but right now you just need to know the term. Next we have the forward rate. Here we discussed कि forward exchange contract एक forward rate पे होता है, but what is that? It is the specified exchange rate for exchange of two currencies at a specified future date. तो एक पहले ही अगर today the rate is $1 equals to 70 rupees and we are deciding today that in future we will enter into a contract with $1 equals to rupees 72 or $1 equal to rupees 68. So that 72/68 is our forward rate that we have predetermined for the exchanges, like for the purposes of exchange in future. Then we have monetary items. These are money held and assets and liabilities to be received or paid in fixed or determinable amounts of money. So monetary items, we will again read this concept later on, but this means the items that will be in which we are using the foreign currency, and these will be the basically the payables and receivables which we need to pay or receive in future at a future date in foreign currency. We have reporting currency. It is the currency used in presenting the financial statement. So we have used this term a lot since the start of this video, and this is the currency of the reporting enterprise. Some other definitions are here. The net investment in a non-integral foreign operation is the reporting enterprise share in the net asset of that operation. So what is a non-integral foreign operation? So there are two kinds of foreign operations. First is integral and the second one is non-integral. The integral means there is like 90% involvement of foreign currency in any business entity that is of the reporting enterprise, and if there is like 10% of foreign currency involved, we do exports or imports in foreign currency, but up to 10% or say 15%, then we say yes, there is non-integral foreign operation. So the net investment of a non-integral foreign operation is the reporting enterprise share in the net assets of that operation. So we know already that net investment is nothing but the enterprise share in the net assets of that operation. So that is what is the net investment in the non-integral foreign operation as well. Then non-integral foreign operation is a foreign operation that is not an integral foreign operation, and non-monetary items are assets and liabilities other than the monetary items. So these terms we are going to deal in detail, but you just need to know that these words exist for now. Okay, now we have the foreign currency transactions. Here the initial recognition, that means when you initially recognize that a currency in foreign currency the transactions are being undertaken at that time. A foreign currency transaction is a transaction which is denominated in or requires settlement in a foreign currency, including transactions arising when an enterprise either buys or sells goods, services whose price is denominated in a foreign currency. So, initial recognition happens that when you undertake any transaction in foreign currency, which requires settlement in that foreign currency only, or for which you need the foreign currency. These also include transactions when you buy or sell any goods or services in that foreign currency, or borrow or lend funds when the amount payable receivable are denominated. So you borrow or lend money in foreign currency, or you buy or sell goods in foreign currency, becomes a party to an unperformed forward exchange contract. So this happens when you undertake any contract of speculation or forward exchange contract, or otherwise acquire or dispose of assets or incur or settle liability denominated in foreign currency. So if you are selling any fixed assets of yours in foreign currency disposing of any asset, or you are incurring or settling any liability in foreign currency. So at these times, you undertake a foreign currency transaction. So at that time, okay, treatment. So a foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between reporting currency and the foreign currency at the date of the transaction. So whenever any transaction will be recognized as a foreign currency transaction, you need to apply your spot rate of that currency, and then you need to record that transaction in your financial statements. Okay, so the one thing that we learned before was a closing rate. Here we saw the closing rate that exists at the date of balance sheet. And during the year, if you are undertaking any transaction, that you have to record at the spot rate. Okay, so let us see this example first. Following is a trial balance of X Limited as on 31st March 2017. So now in between this year, there were several transactions that took place. Here you can see a fixed asset machine was purchased, and it was purchased on that date at 67 rupees per dollar. And here there was again a purchase of goods at 68. Foreign creditor stands at 68. That means you need to, for the purchase that you have made here, you have also a creditor at 68. This represents the same transaction. Then you have a loan for 69 rupees. Sale you have made for 66. Trump debtor 64 rupee. And the date of the closing, because it is trial balance as on 31st March 2017, so they have provided us with a closing date as on 31st March 2017, that is $1 will be equal to 71 rupees. Now here, all I want you to know is there are different exchange rates during the whole year on which the transaction took place. So the date that exists on the date of the transaction is known as a spot rate. These are the dates on which the transactions are recorded in the financial statements of the company. And there is again a closing rate. We will discuss about its treatment later on. But right now you need to know this term, that whenever you undertake a transaction, maybe this was incurred in July, that you purchased a fixed asset, and at that time the exchange rate was 67. So you have recorded this transaction accordingly. So here they mean on initial recognition, foreign currency amount, that means here that was 10,000 rupees multiplied by exchange rate at the date of transaction will be equal to amount in the reporting currency, that is 6,70,000 rupees. So for practical reasons, a rate that approximates the actual rate at the date of transaction is often used. Now I also told you that during the day, every year, there is a little bit of fluctuation that goes on in the exchange rates. So maybe at that time the rate was 67.05. After an hour it was 67.08. So little bit of fluctuation goes on. So you can also take a rate that is approximate to the actual rate of the date of transaction. However, if exchange rate fluctuates significantly, the use of average rate is unreliable. So we need not to go on this. We just need to know that you can use an approximate rate as well, and also the date that exists on the date of transaction. Then we have reporting at subsequent balance sheet dates. So on the closing of your financial statements, what you need to do, the transactions that you have already taken place during the year, you need to, let us read it first. At each balance sheet date, foreign currency monetary items should be reported using the closing rate. Receivables and payables are examples of monetary items. Okay. Now here, FCMI is the short form for foreign currency monetary items. Now first we need to know what are monetary items and what is the treatment for them. This is the same trial balance that I have showed you before, and we will first know what are the monetary items in respect to the foreign currency. It has two conditions. It should be either receivable or payable, and second, it should be in foreign currency. So the treatment that they have shown us, that when you are preparing the balance sheet, then though in specific circumstances the closing rate might not exhibit with reasonable accuracy amount in the reporting currency which is expected to be realized from, in such scenarios the monetary items must be reported in reporting currency at the value which is expected to be realized from or needed to disburse such monetary item at the balance sheet date. Alright, so for monetary items they have said, you can see the very first line, that they should be reported using the closing rate. सो पहले आपने क्या किया, जब आपने कोई भी एसेट परचेज करा या आपने कोई भी परचेज करी इन फॉरेन करेंसी, आपने अपने अकाउंट्स में उसको उस डेट पे रिकॉर्ड किया, उस प्राइस पे रिकॉर्ड किया जो कि स्पॉट रेट था उस डे का. नाउ नेक्स्ट थिंग दैट यू हैव टू डू, जब आप बैलेंस शीट बनाएंगे उस टाइम पे आपको क्लोजिंग रेट प्रोवाइडेड है, दैट इज $1 इक्वल्स टू 71 रुपीज़. तो फर्स्ट यू नीड टू कैटेगराइज कि आपका फॉरेन करेंसी मॉनेटरी आइटम्स कौन कौन सी हैं. तो दे हैव सेड कि आइदर रिसीवेबल और पेबल होनी चाहिए एंड देन इट शुड बी इन फॉरेन करेंसी. नाउ फिक्स्ड एसेट, इज दिस अ रिसीवेबल और अ पेबल? नो, बिकॉज आपने मशीन खरीदी है, इट इज़ एन एसेट फॉर यू, नॉट अ रिसीवेबल और अ पेबल. आपने परचेज किया है, सो यू आर परचेजिंग गुड्स. परचेज इज नेवर a receivable or a payable, but if you have made credit purchase, so that creditor is a receivable or a payable, right? But here you can see जिनके आगे भी आपको spot rate दिख रहा है, that means they have been undertaken in the foreign currency. But here the creditor, it seems to be in the reporting country only because there is no exchange rate over here. तो ये आपकी second condition satisfy नहीं कर रहा. That means the monetary item is not in foreign currency, so it is also not a FCMI. Then foreign creditor, since creditor is a payable, that means someone that we have to pay in future, और वो आपको ये भी दिखा रहा है कि it is a foreign creditor, that means it is representing a spot rate, so it is satisfying both of these conditions, and then it is a FCMI. Then we have loan. Loan is again a payable and also it is shown in the foreign currency, therefore it is also FCMI. Sale is neither receivable nor payable. Sham debtor is an Indian debtor, neither receivable nor payable. Trump debtor, that means a foreign debtor, also the rate has been provided, also it is a receivable, so therefore it is FCMI. Bank and other assets, they do not qualify for FCMI. So when we have identified कि हमारी कौन कौन सी items FCMI हैं, तो हमको उन्हें closing rate पे एक तरह से denote करना होता है. That means we have already mentioned here the rates at which the transaction was taken place. अब 71 and 68 इनका जो difference है, that means ₹3. अब हमें इन debtors को हमने जब इन creditors से या इन debtors से पेमेंट लेनी है या देनी है, उस टाइम पे अभी हमारा रेट 71 हो गया है, पर जब हमने ट्रांजैक्शन किया था इट वाज अ डिफरेंट रेट, सो ये हमें इफेक्ट करने वाला है. ओके, सो दैट्स व्हाई ये इसका लॉजिक है कि व्हाई वी नीड टू सी द आइटम्स दैट क्वालिफाई फॉर द फॉरेन करेंसी मॉनेटरी आइटम्स, बिकॉज ये हमें इफेक्ट करेंगे. हमने जब ट्रांजैक्शन अंडरटेकन की थी तो हमारा रेट 68 चल रहा था, बट नाउ क्लोजिंग रेट 71 हो गया, यानी कि हमको इस क्रेडिटर को ₹3 एक्स्ट्रा पे करने पड़ेंगे फॉर एवरी डॉलर दैट वी टुक फ्रॉम हिम, राइट? तो इसलिए हम रिसीवेबल पेबल को मॉनेटरी आइटम कहते हैं एंड इट शुड बी इन फॉरेन करेंसी. दैट्स द रीजन हम इनको क्लोजिंग रेट पे डिपिक्ट करते हैं, बिकॉज इट विल रिजल्ट इन अ लॉस. नेक्स्ट, ऑल्सो वी नीड टू क्लैरिफाई कि इनमें से हमारी कौन सी शॉर्ट टर्म आइटम्स है, कौन सी लॉन्ग टर्म आइटम्स हैं. जैसे फॉरेन creditor is always short term, and here also Trump debtor, he is also short term, matlab they are usually paid within 12 months of the transaction. And then loan, we consider it a long term, so these all are FCMI and they will always affect the giving or taking of money, so they are always mentioned at the closing rate. और जो भी इनका difference होता है spot rate का and closing rate का, that is the exchange difference. Then we have, so we read till here, and so these are should be reported using the closing rate. Then the non-monetary items will be other items. Okay, like the fixed assets, purchases, creditors, and the other items. These are carried in terms of historical cost denominated in a foreign currency should be reported using exchange rate at the date of transaction. So fixed asset inventories, investments, these are all examples of non-monetary items, and just rate पे they have been shown. उसी rate पे we need to carry them. मतलब अब ये हो गया, purchase तो हो गया, इसका कोई future implication नहीं है, so we will carry them at same rates, that is over here in the Indian rupee or the reporting currency. Also, the non-monetary items which are carried at fair value or other similar valuation denominated in a foreign currency should be reported using exchange rates that existed when the values were determined. They are also saying कि अगर अभी तक कोई भी item आपके reporting business में foreign currency पे है, तो you need to record it at the fair value and in the Indian rupee. So for monetary items, we have foreign currency amount will be at closing rate multiplied with the closing rate, and then you will get amount in the reporting currency. So cash, receivables, and payables are examples. Then we have non-monetary items. When valued, if they are valued at historical cost, so rates at the date of the transaction, that will be the rate at which they are recorded, and when at fair value, rates that existed when the values were determined. Fixed assets, inventories, investments, and equity shares are examples of the non-monetary items. So guys, that's it for today. Okay. These are the courses that are available with us, that is the www.crackgradeb.com. You can check them over here. These are the star performers of our academy. And thank you and happy learning.